Good evening. This is Ken Long from Tortoise Capital Management with a review of the weekend reports for April 7th, 2012. Happy Easter. We have a bullish normal market. We're on the low end of normal volatility. 66 out of 100 on annual weekly RSI, so that puts us at the high end of neutral. 34 out of 100 on the 10-day NDX, so low end of neutral. The percent stretch relative to the 200-day moving average is green bullish at 10.93%, so still strong bull. The 5-day slope of the 50-day moving average is 0.68%, so that's white bullish, still strong, but not as strong as it was last week. ADX 14 is at 28.4. It's pulled back from 34 where it was last week. It hit a high of almost 40. So it's back into the normal territory where we would say the trend is strong. However, having come from a height of 40, this definitely feels like the trend is weakening. There's still enough strength of trend, however, to have a general strategy of buying on dips. Relative volatility is 0.96%, and that's at the very low end of normal, right on the cusp of quiet. So we've got a bull normal market in neutral conditions. The blended monthly rebalancing portfolios, just for review, the Qs, financials, and mid caps, and the 13 ETF is Qs, mid caps, and small caps. This should read 1 May, next reevaluation on or about 1 May. In ETF2, the theoretical exposure is still at 100%. The model portfolio is exposed at 100%. Here's a quick look at the ETFs in the blended monthly rebalancing portfolio. You can see Qs, large caps, real estate, mediums and smalls at the top, all the globals at the bottom. Only treasuries are on a cash signal. In the 26 ETF portfolio, financials remain at the top, treasuries at the bottom, with agriculture, gold, Swiss franc, the energy sector at the bottom. U.S. remains at the top, so this is still a risk-on trade favoring the U.S., but the bull is starting to show a little bit of age right now. Looking at the market health check, the vertical blue lines are 10, 20, and 30 days worth of look-back period. I have this registered still at bull quiet because we're right on the cusp of bull normal. I will change that to bull normal for this week, however, because it's been coming up on a week that we've come out of quiet. The black line in the center is the 30-period regression line. The outer black lines are the channel that are formed by the maximum excursion from that regression line, which occurred about March 7th. I've extended the channel forward in time so that if the strength of the market continues unchanged, this is where we would expect price to be in the times ahead. You can see that it is below the regression line and below the 10-period moving average and coming down to test the lower channel. If this channel is to remain unchanged and the underlying premise of the market to remain unchanged, then we would expect to see support around this level, about 140. The horizontal red lines represent support levels from previous time frames that held. These two red boxes represent a 5% pullback, which would be just below the 50-day moving average, and a 10% pullback to 128. And pullbacks from 0 to 5% from the swing high of 142 represent normal market noise. So we would expect the 50 in that case to be strong support. Pullbacks of 5 to 10% would be classified as corrections in a bull market. So that's how far it can fall and still have a generally positive outlook according to talking heads. You can see on the Williams percent R, it is pulled back to just above the oversold condition. The jaws of PPO, percent price oscillator, have opened to the downside and have been that way for about a week. It started getting measurably weaker here when it failed to break out above 142. The slope of the 30-period regression line is this time series here. You can see it has also rolled over. It's still above 0, so that's favorable. That means the slope is generally up, but it's starting to weaken. As a point of reference, you can see in the last surge that ended at 132 just how steep that got before the slope got weaker. ETF2 regional report, all 10 indexes are on a buy signal. That means the model's at 100% invested, 0% cash. SPY is better than EFA, meaning that 64 is better than 56. Inside the U.S., the strength is technology, then large caps, then mid caps, then small caps. That's really the strength of Apple, is what it looks like. The two strongest sectors of the regions are the tech and U.S. large caps. The two weakest are Japan and Asia less Japan. World market model, the U.S. is above average, and the Qs are definitely above average, the large cap growth. Latin America, emerging markets, and Brazil are all above average. Mexico especially above average. Canada weak, like all of the other commodity countries, for example, Australia. In Asia, Japan is below average. Asia less Japan is above average. The leaders continue to be, like they have been for the last year, South Korea, Taiwan, Singapore, Malaysia, and Hong Kong. Laggards are China, Australia, and India. Everything in Europe is below average except Belgium, Germany, and Sweden, so strength is coming out of the Eurozone. The risk on trade got markedly weaker this week as materials and energy started to pull back. Right now we have only finance, industrials, and technology above average, and now we're seeing discretionary and healthcare coming back as part of the defensive plays. I would, if that trend continues, then symbol XLP, the staples, ought to be an interesting play. ETF top 30, dominated by the same names, been little to no change here among the leaders. Home construction, biotech, retail, technology. Really extraordinary to see the Qs this high. I mean, a big Fed index like that, and I attribute again that to unbelievable strength in Apple, and that has me concerned, frankly. Technology, retail, regional banking, semiconductors, financials in the top, pharmaceuticals as well. Same methodology with the Dow 30. What I've done now is I've added these Dow 30 into the ETF 500 database so we can see exactly where these big fat companies are with respect to world opportunities. I think this gives a fair treatment of their ratings on these different scales. You can see Bank of America, just extraordinary. I've got this sorted by the blended 3 and 6 month relative strength, the strength column. Bank of America, JP Morgan, American Express, 3 out of the top 5 are financials. Caterpillar and Home Depot, recent trading favorites of ours. Round out the top 5. Bottom 5, HP, Verizon, and then you see the weakness in Chevron. But Johnson & Johnson, McDonald's have been lagging. Now, I consider Johnson & Johnson, McDonald's, and Procter & Gamble, which were the winners of the last 6 months of 2011, are now the laggards. Those look like some sector rotational opportunities to me, that if we see money start to come out of these overheated financials, that those three look pretty interesting. XLP, once again, would be a way that you could play those broadly with a single instrument. But those are definitely on my stalking list. What I really like is McDonald's here. I want you to notice it's green on the quality rating, and then yellow on strength and consistency. So that represents a recent pullback, and it's still above its moving average signal. McDonald's becomes an interesting stock right now. ETF liquidity, again, these just represent the ETFs that have the largest average daily dollar volume, which is share price times average daily volume of shares, and then their ATR percentage intraday. You see trading favorite here, VXX, is over 7% intraday volatility. Time series, this is how much volatility has come out of the S&P over the last 6 months and over the last 5 years, based on a time series of its 30-day standard deviation, and we're at the low end of historical quiet over the last 5 years. You can see anything kind of below this 0.50, which is where we're at. This is extremely quiet. Has bottomed recently. Now we've just started to see an up spike in volatility here after exceptional low. And I think that's part of the interest we're seeing in VIX, is that people are saying it's quiet, yeah, too quiet, and they want to preserve the gains of this big bull, and that's one of the ways that you would expect to see portfolio insurance being manifested, and that is in improvement in the price of VIX. Let's see, we were going to go ahead and skip ahead now to the daily. All right, now we're over to the daily report. I'm not going to redo the top row. Signals in overreaction system for small caps, Euro Asia blend, Latin America, and Euro 350. You can see the 10-day NDX is pulled just above the oversold condition. See just how much volatility has come out of the market here. You see ADX rolling over. Bulls are still in charge, but it's getting measurably weaker. 10-day max pains, Bank of America, General Electric, Alcoa, Verizon, and Cisco. Alcoa and Verizon should be of interest. Very, very tradable. Lots of channeling signals both on the ETF side and the large cap side. Lots of overreaction signals on the large caps. Triple screens and 551W is available on large caps as well. Everything in the auto framer represents symbols that have tested out at higher than 2-to-1 reward to risk ratio on the basis of testing their 10-day high and using mechanical entries. I've slightly changed this array so that we get all of the swing trade signals on there. And I've also changed up the Dow tactical summary and added the overreaction long and short signal columns in here, and added the formulas for the intraday statistics down here, as you can see. And that covers, what the calculations for range stat, frog standard deviation, frog quality number, the fail stat, and the signal to noise ratio are. If we get overreaction short signals, then that cell is going to light up the color of red to give us a reminder that it's a system that can go short. So now I've got all of the mechanical swing system signals added in here, and including the doji and the max pain range compression. I'll be uploading an edited copy of the spreadsheet to the website, to Basecamp, for those that are playing along at home. Same with the ETF 30. I've added the overreaction signals in here. I want you to just notice just how many symbols are testing out very well on the auto framer. Lots of opportunities in here at better than 2-to-1. So I hope you like the new report. Regression line, you can see the R-squared at 0.68 is still relatively high, but we've had two significant pullaways on the downside. This is where where the bulls want to be buying on dips and respect this strength at 139, but we'll see. If it fails at 139, it looks to me the next level is about 135 is the target. You can see on the longer term time series, we're just at normal levels here, and there's no long-term signal that's indicated by that. You can see just how strong this move off the bottom has been. This is the price with respect to the 200-day moving average. It moved almost 2 standard deviations above normal here, and is kind of rejected going higher for right now. You can see we're picking up some sideways price action, and that's part of the reason why the regression line has crossed back over its 10 period and started to move lower. Very hard for S&P to sustain that kind of strength that we've seen in the last 3 to 4 months. Frog quality numbers just for reference, fail stats just for reference. I'm not going to read those to you. Signal to noise ratio, really anything over 0.5 says there's more real body than wick, and an extraordinary number. One of the things I like about trading the VIX as an example is that it's very directional, that its real body is 0.51, and that's just about as good as it gets in terms of directionality. American Express is going to be an interesting one, AXP. We saw that on a mechanical frame earlier, and it has a very strong signal to noise. So that's a very directional, intraday trending symbol in the strongest sector in the market. I also like that McDonald's has a strength of greater than 0.51. Generally how I use this is if they're in the green, once that trend starts, I prefer to get on those. These make very good frog trade candidates because of their directionality intraday. These ones at the bottom, however, tend to be ones that if I get the move in hand, I'm more inclined to take that move because they tend to reverse direction quite a bit and have longer wicks than real bodies. Holding X-day periods, really the thing to notice here is that only the Qs are positive over the last 5 days. Everything else has a negative Z-score, meaning that the market has definitely pulled back, but the Qs have pulled back the least on a percentage basis. Euro-Asia at a minus 0.85 represents a relatively large pullback, as has gold. So Euro-Asia blend has lost almost 4%. 3.4% in the last 5 days, 3.2% in the last 10 days. So this is a relatively recent phenomenon. So weakness in the rest of the world rather than in the U.S. Whereas Europe has lost 3.14 or 3.41%. U.S. has only lost 0.72, and the Qs are actually up 0.25%. So that's how you read that. This is a quick measure of relative strength, looking at 40 days, 20 days, 10 days, and 5 days of holding compared to their historical norms of the last 5 years. You can see commodities are starting to get better here. These are their 30-day regression line slopes compared to the S&P, and so there's some strength coming into gold. It's stealthy, but I'll be looking at gold and silver and the rest of the commodity group here. And that's basically everything I want to cover on the daily. The rest of these are for reference purposes as you frame your trades, your swing and longer-term position trades. So this is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured. And happy Easter.